Hi, my name is Kevin Vandermeer. I'm a managing director at Canaccord Genuity Wealth Management. Today, my guest is Martin Roberge, a North American Portfolio Strategist.
All right, thanks, Kevin, for having me.
Great. Today, we're going to be talking about or asking Martin questions about the current market conditions. So let's start. How legitimate are these tariffs as a strategy that the Trump administration is proposing?
Yeah, there's some case that a case can be made where, indeed, like when you look at overall tariffs around the world, the U.S. is probably the country that tariffed the least foreign goods. So you've got about probably 2 out of 3 countries that are putting higher tariffs on U.S. goods compared to U.S. tariffs on foreign goods. So there's a case that can be made where some negotiations must occur to recalibrate the differential in tariff rates among countries. Obviously, the question is, is the approach being used by the Trump administration too harsh of an approach? And obviously, that's open to a lot of debate.
Yeah. What are the implications, essentially, of a tariff?
A tariff is a tax on consumers all around the world. And when the two biggest economies in the world are going after each other, obviously it creates a lot of uncertainties and volatility. But what we have to understand is that global trade has been around for about 20 years after China joined the WTO in 2000. And that has allowed global trade to boom because we were basically operating in a world where countries that had an expertise or a hedge in building and manufacturing stuff at a low cost took a big share of the export markets, and consumers, obviously, in advanced economies that are wealthier than in the emerging markets, for example, could buy those goods, and rich countries like the U.S. and Canada would focus more on the services rather than on the manufacturing.
Right.
So everything was working relatively well until we had the Trump administration trying to change the order for global trade, and the net result for now is one where consumers will be probably dealing with higher inflation and where global trade will come down. How far? Well, it depends on the outcome of the current negotiations between Mr. Trump and a bunch of countries.
So let's now shift and talk a little bit about Canada. So far, Canada has been spared from reciprocal tariffs, but maybe just talk about what this means for Canadians and the Canadian economy.
Yeah, right now Canadians are facing an average tariff rate of 14%. Okay, the good news is that there could be an easing in those tariffs coming first from the fentanyl-related tariffs. I think there's a good chance that they kind of go away. We've seen Republicans in the U.S. putting pressure on the Trump's government to eliminate those tariffs. The second good news is that if you look at the CUSMA agreement, which is the old free trade agreement, about 40% of our goods are compliant, hence not really dealing with tariffs. Tariffs are at zero for these goods. This 40% is likely to move closer to 75% if companies are making more of their goods compliant to this agreement. And we know from some of the analysis that we've done that a lot of components that we manufacture have a U.S. percentage of the component at around 40%. So if we just can flip it to 50, 51, 52,
right,
that would make those goods compliant. And if we measure the impact of removing the fentanyl tariffs and border tariffs, and also making this percentage of goods compliant to 75%, the average tariff rate goes from 14% to 5% only. But since the Canadian dollar has already declined by 5% over the last 6 months, I would say, well, it neutralizes the impact of tariffs. So that's basically going back to square one when it comes to the impact of tariff on Canada.
So for Canada, the real opportunity is to really move, to change the manufacturing or that we're doing so that we're more compliant.
Well, that's probably the priority. The second priority will be to make sure that we keep some good relationships with the U.S. As much as we want to diversify our economy, we have to remember that if Europe and Asia have to deal with higher tariffs, chances are that there will be fewer goods from these countries going to the U.S. And that's an opportunity for Canada to capture those market shares. Okay, so we're going to be probably capturing more volumes because, again, Europe and Asia are not going to be sending as much stuff down to the U.S. And also in global markets, I think that it's fair to say that there will be less consumption of U.S. goods because of the tariffs. So Canada can capture some of the volumes left by the U.S. Okay,
right.
So we have obviously the cheap Canadian dollar is helping for the U.S.,
Yeah.
but the cheap Canadian dollar relative to the euro is also helping or will facilitate the diversification away from the U.S. into global markets.
Right. Do you think we're sort of at kind of peak tariffs at this point? It feels like we just had the time of filming right now. We've had this 90-day pause.
Yeah.
Do you think we're at peak tariffs?
Yeah, we're past peak, I would say peak tariff hysteria, okay? Probably nearing peak retaliation risks, okay? But unfortunately, we're maybe not at peak uncertainties or economic uncertainties. We are probably shifting the risk from a financial market point of view from tariff risks to the business cycle risk. And the business cycle risk is dealing with a slowing of the global economy, U.S. economy, Canadian economy, and hoping that central banks will be able to accommodate and provide some oxygen to the U.S. and Canadian economy so we can escape a recession where odds are probably 50-50 right now. But if we do have some help from the central banks, maybe we can escape a recession and continue to grow in the second half of the year.
Right. So let's shift a little bit and just talk about the Bank of Canada. Obviously, with tariffs, there's an increased risk of inflation in Canada, and as you've just highlighted, a shifting towards, the probability of a recession. Yeah. So do you think, the Bank of Canada is on pause now, or do they continue to cut?
Yeah, they will likely continue to cut. Just to understand, there's a big difference between the Fed and the Bank of Canada. The Bank of Canada is dealing with an economy where leverage at the consumer level and at the corporate level is really high. If on top of that you add the slowing from the tariffs, Canada is expected to slow down probably more than the U.S. And the U.S., the issue is that you've got this tariff-induced inflation that will keep inflation much higher than it should be, while in Canada, obviously from the auto tariffs, we're going to have some inflation. But as we say, the spare capacity or the slack in the economy is probably large enough to absorb some price pressures, so that the Bank of Canada, knowing that the economy is expected to absorb the impact of tariffs, will probably reduce their interest rates so that those rates, or what we call the Bank of Canada rates, are lower than inflation. Historically, to stimulate or to protect the economy, you have to have your policy rates below your inflation rate. And right now, inflation is around 3%. BOs, like Bank of Canada rates, are 2.75, so they can easily cut 2 or 3 times to have like a negative spread, or what we call a negative policy rates. And this is usually what you need to do to stimulate or at least protect economic growth. So I think you'll get 2 or 3 more cuts in 2025.
Okay. Let's talk a little bit about the bond market.
Yeah.
We saw yields come down and then move back up.
Yeah.
Maybe talk about why are bond yields not coming down given the backdrop that you've just discussed?
Yeah. So I would say one key reason is that if you look at the tariff being imposed on China, like rising almost every day, well, there will be an impact on inflation. Okay, no doubt about that. Whatever we will pay for China goods, those prices will be higher. And U.S. imports of Chinese products, that's about 15% of U.S. imports in total. So you're talking about a 2% increase in CPI or in the consumer price index just from China alone. So the bond market is certainly concerned about that.
Yeah.
The other story is one where now the bond market could be used, could be a tool being used by countries such as Japan and China, a tool to retaliate against the U.S. because investors have to know that Chinese investors are China and Japan, their central banks are the biggest holder of U.S. Treasury bonds in the world. So if Mr. Trump is not kind to them, they may be tempted to sell some of their U.S. Treasury holdings, putting pressure on yields. And eventually, this is a story maybe for next week or the next month, but the Federal Reserve may have to intervene in the bond market to stabilize conditions.
Right. Okay, so let's now shift and talk about, say, the Canadian dollar, the U.S. dollar. If somebody has U.S. dollars, would you consider this a good time to move back into Canada? And how are you thinking about kind of FX in general?
Yeah, the timing is like a lot of folks had been looking maybe for the Canadian dollar to go back to historical lows around 62, 65 cents. Right. It's not happening right now, and the reason is very simple. Obviously, various factors influence the Canadian dollar. Rates, economic growth, but there's a key factor which we call portfolio flows. Portfolio flows are foreign investors buying our Canadian bonds or Canadian stocks, okay? And what we've seen over the past, I would say 6 to 9 months, is a return of foreign investors towards Canada for their bonds, because for reasons that we mentioned, the Canadian economy is expected to slow, so that will put downward pressure on bond yields. And then for Canada, it's just part of that broad diversification away from the U.S. into like markets that have lagged. Right. Okay, Canada is part of that basket. And when people are buying more Canadian financial assets and selling U.S. financial assets, like we've seen so far this year, well, it creates positive pressure on the Canadian dollar. And this is why probably we've seen the worst, maybe not out of the woods, but I really doubt that we go back and retest like the 62, 65 level. And quite frankly, I think we could look at a number closer to 80 cents in 2 to 3 years from now.
Martin, let's talk a little bit about U.S. equity markets. Yeah. Right now, we're in a bear market. The market is pulled back, greater than 20%. Do you think there's further downside risk from here?
Most likely, we've seen maybe more than half of the adjustment that needed to be made. The rule of thumb is very simple. When you believe that odds are about 50% to have a recession, the stock market will go down 20%. That's what we call the price adjustment. Then, as you know, equity markets are driven by earnings. So there has to be also what we call an earnings adjustment. So if we have a contraction in economic activity, we'll have also a contraction in earnings. Right now, we're looking for an earnings contraction of about 5 to 10%. So on top of the 20%, we're talking about maximum downside risk of 25, 30%. So we're at 20% right now. So we're not that far. And history is very clear too. Once you drop to the 20% mark, 1 year forward returns are skewed highly positively unless we have a financial crisis like we had in 2001, 2, 2008, 9.
Yeah.
But according to, if you'll go back to these two episodes, back in 2000, there was too much corporate debt as companies were financing the fiber optic rollout with debt instead of free cash flow. Now, yeah, we've seen a good CapEx cycle for AI, but it was paid with the excess cash flow of companies, not debt. In 2008, the problem was the consumer wanting, or households wanting to buy a house, and we had a housing bubble that was financed by again, too much debt. Right now, we don't have an excess of debt or an excess at the corporate level or at the consumer level. So the imbalance, okay, that we had back in those days is not there. So that makes me believe that when you tack on or you consider the fact that it seems now that the Trump administration is sensitive to the market, we're not dealing with a potential financial crisis, okay? So my hunch is that when I look at the various sectors of the market, defensive stocks, which is what you buy when you're afraid, are not rich enough, okay, for people to sell, okay?
Yeah.
And what we call the more cyclical stocks are not cheap enough to buy. So when you look at the gap between the two, according to our calculations, we're probably 5 to 10% away from a buying zone. Okay, so I would say that probably stick to some defensive exposure, keep some powder dry. We may not have to wait on the dentist chair too long.
Right.
It could be like happening in this quarter. But one thing is for sure, when you look at global equities in general, the last few months have shown that diversification is key. Diversification outside like the US, okay? And obviously across sectors as well. Diversification is important.
Right. Let's shift a little bit now, talk about commodities and specifically oil. Oil has dropped now below $60. Give us your thoughts on that, where it might be in 6 months or 12 months.
Yeah, we think it's going to probably be oscillating in the $60, $70 range. There's obviously a risk that we undershoot in the near term because oil demand is expected to moderate owing to the slowing of the economy. But the silver lining is that current prices are too low for producers, especially U.S. producers, to increase their drilling activity. It's just not profitable. Like the break-even cost is about $60, and we're below. So you're not going to see much supply coming from U.S. producers or even Canadian producers. So this is putting a floor. Is it 50, 55? Hard to say. But on the upside, you still have OPEC Plus with about 2 million barrels a day of excess capacity, of excess supply. So they can always use this excess supply. And actually, OPEC Plus has said that they're going to be allowing some of their members to start producing again. So it's putting a cap around $70 probably. So the range $50-$70 is probably the range we will be in a year from now. But that's obviously good news for the consumer because we're going to be enjoying like low gasoline prices for at least another year.
Right. Let's just go back to rates again. If rates are coming down, is this a good time if you've got a mortgage to lock in? Maybe talk about again rates, where they're going, and in particular mortgage rates.
This is this the shock or the end of globalization is likely to shift the inflation cycle from one where we deal with cyclical inflation to what we can call secular inflation. So inflation is likely to be higher than normal for a few years, okay? So that we need to adjust supply chains. It's going to be costly. So pricing pressure are likely to stay high for a little while. So the medium to long-term outlook for bonds is kind of neutral to slightly negative. But in the near term, we have a window of opportunity where we have the Bank of Canada, for example, that will be probably reducing interest rates. And that will probably also lead to lower bond yields and lower mortgage rates. So like I have a daughter, I have a son looking to buy like real estate, a house or a condo. Yeah. And I told them that probably this summer or this year might be the last opportunity that he can secure a mortgage rate under 4% in Canada. So yeah, I think it's a good environment for people looking for some low rates to buy something obviously affordable.
Right. Martin, thank you for taking the time to sit down and to talk about these volatile markets and answer our questions. So,
all right,
thank you.
Thanks for having me.